Hello and welcome to Module 1 of the Agreement for Sale Cash Cow Formula. I'm your host, Sherilyn Milsom, and today we are discussing the basics of Agreement for Sale as well as marketing. First, some ground rules. Make note of your questions throughout and bring those to the Q&A session that we're having soon. And you can email your questions in advance to sherilyn@sherilyn.ca. And that is helpful if it's a more complicated question or if you want to keep it confidential. Remember the membership portal for replays and for all the documents you need, as well as copies of the slideshow. And please protect all documents, refrain from sharing or duplicating. So these documents that I do provide for you are for your personal use, but not to be shared as your own. And be sure to do your homework. Now we're going to cover that at the end of the session today. I will let you know what your homework is, and you better darn well have it done when we get to the Q&A session. All right, so on today's menu, first we're going to cover the basics, and there will be some review in there. What is an agreement for sale, of course, and when can you use it? Then we'll go deep into marketing. Prospects versus suspects is an important question, and we'll cover the various marketing methods in a bit of detail. Also, we're going to cover what to say to sellers and how to get all the information you need. So you've got no money, you've got no mortgage. Well, that really is no problem. I haven't applied for a mortgage since spring of 2016, and I've bought multiple properties with almost zero down payment. As some of you may recall, we built our corporation with zero of our own money and built it into an 8-figure portfolio. And that was all with creative strategies. We've had no need for money partners, for investors, for RSP loans, or for joint ventures. And how we do that is by creating a win-win between the buyer and the seller. I get to add a property to my portfolio. The return on investment is nearly infinite because, of course, we're buying with little to no money down, and often we're getting money from rent-to-own tenants as well. So it pretty much is infinite. And of course, we have those multiple strategies to hold and later exit the property, and we will cover those in detail another day. And one of my favorite things, there is no need to qualify for a mortgage. So that means that if you have self-sustaining properties and no mortgage qualification and little to no money down, your buying potential is almost infinite. And of course, we're creating a win for the seller as well. The seller gets to unload the property with no hassles and no fees. They have no realtor's commissions. They have no fees for breaking the mortgage. And while we do recommend that sellers consult with their own independent counsel, they don't have to go consult a lawyer if they don't have the money to do so. And that is sometimes the case. So if somebody can't afford to or refuses to go see a lawyer, we can still deal with them, and they would just sign the documents at our lawyer's office under the strict advice that the lawyer is not there to advise them, only to witness their signatures. Of course, we close whenever the seller wants, and that is one of the biggest draws for sellers to agreement for sale purchases or sales. We have a few different ways to close, whatever works for them. In some cases, it's a super quick close because they either are moving right away, maybe they've been trying to sell for a long time and now they're down to the wire, or maybe the debt is finally really coming to a head and they are facing foreclosure and they need a super quick close. Sometimes it's a quick close with a short lease back to the seller. And that is especially helpful when sellers need a bit of time to move and find their new place, but they can't deal with the burden of debt that they have. So we have done that in a couple of instances. Of course, A, that is only a very short-term thing to lease back to the seller, and B, often the lease payments will come from the total sale price of the house. That way, the seller is not out of pocket trying to pay rent and also get a handle on their finances in order to move. So that's a real draw for them. And of course, there's also the long and or flexible close. This is more for people who have already bought a new house and they're waiting for possession, or they are having a house built and they don't know yet when that date will be. And the reason they would want to work with agreement for sale is because they don't want to either have two mortgages at two different properties or be stuck with, yay, we've sold our house. Now we need to find another place to live for 6 months and then move again when our new house is ready. So this is a great option for them. And of course, it saves the seller's credit and their sanity. Can you imagine the stress that somebody must be going under when they're behind $5,000 on their mortgage? They don't know how they're going to ever catch up. They don't know how they're going to make the next mortgage payment when they can't make the first five. And they see no option. They see no way out, no light at the end of the tunnel. The stress must be terrible to face the possibility of foreclosure and homelessness. So this really saves a lot of people. When and where does it work? Anywhere with a solid economy, preferably diversified. And what we mean by that is there are multiple different industries, large job providers in the area. So it could be hospital, university, oil and gas, and manufacturing sector. That's a pretty diversified economy. If you compare it to some place that is an oil and gas town, for example, where the main industry is oil and gas and everything else in that town supports the oil and gas industry, if there's an oil slump, then that means the whole town's economy contracts. And that can mean huge fluctuations. So when we have a diversified economy, there's more stability in the market in general. There are less severe price fluctuations in real estate. And you have a bigger renter pool, because if you have that one horse town and the market contracts, everybody leaves Dodge. So if you have a more diversified economy, there are more employers, more industries, and chances are there's going to still maintain a fairly healthy renter pool and also buyer pool. So definitely diversified economy. It can work in virtually any market. Rising is great, especially if it's early in the recovery phase where the consumer confidence isn't quite there yet, but you're fairly confident the market's going up, but the general populace is not yet confident of that. That is the perfect time to buy because you're going to have an increase in equity most likely, and that's a great win. In a flat market, it also works great because there's a lot of opportunity. There's a more balanced supply and demand in a flat market. Sometimes it's even a buyer's market, and the sellers are going to be more open to a more creative solution because they have limited options. By the way, in the rising market, once you hit the boom phase, it is a lot more difficult to make agreement for sale work because people can sell to whomever they want. There's a bigger demand. There's a lot of buyers out there. And so people wouldn't necessarily need to stay on title and mortgage in order to sell their house. There would need to be compelling reason, but it still can be done. It's just less common in a boom. Now, in the flat market, you do need to be careful as to where the market is heading. Is it flat because you're heading towards recovery soon, or is it flat because it's potentially starting to decline? So that's something to be aware of for your specific market. And in a falling market, it can still work as well, but you must get free equity and a lot of it in a falling market. Now, on the plus side, people's options are more limited. They're definitely going to be more willing to get creative. But like I say, you need to prepare. You need to have that cushion against those falling prices. So for example, if it's a $400,000 house and you anticipate that it easily could be a 10% decline in price, that's $40,000. So you would want to pay at the absolute maximum $350,000 to accommodate that 10% plus decline. Now, another thing with falling market, you want to have flexibility in the length of your term and renewals. And we'll cover all of this in great detail in other modules. And of course, this works on single family, multifamily, and commercial. And it's more common in multifamily and commercial. Sellers are more used to dealing with this. So what the heck is it? Well, of course, we're talking about agreement for sale, or AFS. There are a lot of other names for it: agreement to purchase, agreement of sale. Getting the deed is the common term in the US, and subject to is also more common in the US. But we're going to go with the first one, and often I'll just call it AFS. So an agreement for sale is a way of purchasing a property using seller financing. And the mortgage stays in the seller's name. We get beneficial ownership, but not title. Title also stays in the seller's name. So he is still the legal owner. We are the beneficial owner as buyers. Now, beneficial ownership means you have operational control. You can do whatever you want with the property. You can rent it, sell it, rent to own. You can assign the contract to somebody else and take an assignment fee. You can renovate the property, even substantial renovations that require permits. You can do a fix and flip, or you can even rip the building down and develop it into something else. So you may find a property. I actually had a call the other day I haven't followed up on yet, where the property is selling for lot value. It's a 1930s house, and the property is selling for lot value, and it's in a pretty decent neighborhood. So I do need to follow up on that, because I could potentially get that property on agreement for sale without having to get a builder's mortgage, and then turn around, tear that property down and develop it, and then, well, do whatever I want with it. Of course, in that case, I would probably either sell or refinance. You wouldn't hold it on agreement for sale for long term if you're doing a major redevelopment and really increasing value. Again, that's something we'll cover in more detail later. Now, how we do this is on a regular purchase contract with an AFS clause to clarify that we're closing with an agreement for sale document rather than a mortgage. That is key to this. And the clause says this transaction shall proceed by way of agreement for sale. Then we have a financing schedule that has all the details of the payments, the interest rates, the amortization, the timelines, all of that stuff. And that can be either in the additional terms section of the purchase contract, so built right into the purchase contract, which is how I like to have it here in Alberta, or as an addendum to the contract, so a separate document that forms part of the purchase agreement. And this is location dependent, because as I say, in Alberta, we can have it built in. But in other provinces, they're very limited on what changes they can make, and states as well, I'm sure, on what changes they can make to the standard purchase contract that is used and created by the real estate council of that area. So in that case, they would need to have it as a separate addendum attached to the purchase contract. So an agreement for sale document is like a mortgage between the buyer and the seller, and it outlines the seller financing terms, the consequences, and the details of the eventual completion of sale and transfer of title. It's a several page document that puts everything on the table, all of the rights, responsibilities, consequences, and of course the details of the sale itself. The definition: an agreement of sale constitutes the terms and conditions of sale of a property by the seller to the buyer. These terms and conditions include the amount at which it is to be sold and the future date of full payment, just to get technical. So here's a bit of history on agreement for sale. How it came about was because banks used to require 50% down payment. Can you imagine having to come up with a 50% down payment today? Well, they didn't like it back then either. So sellers decided to get creative, because there was a really small buyer pool of people who could pay 50% down on a property. So they got creative and figured out the agreement for sale purchase strategy. And that worked great for many years until CMHC was created in 1946. And then, of course, with insured mortgages, banks felt comfortable lending 80% loan to value, and that opened up the buyer pool to a lot more people, and there was less need for agreements for sale. So it kind of fell out of favor. Now, later, when assuming a mortgage became more difficult, And I remember those days here in Alberta, everybody used to assume mortgages left, right, and center. And then suddenly the rules changed and it became almost impossible for an investor to assume a mortgage. So that's when agreement for sale came back into favor. Now, agreement for sale and vendor takeback often get confused because a lot of people assume that a vendor takeback is the same. It's not. Vendor takeback mortgage, in that situation, it is seller financing, but the title transfers to the buyer. The seller is not on the main mortgage or on title. That does transfer. So there are two ways to use vendor takeback. The buyer can get a conventional mortgage, so a 20% down mortgage, but the seller then lends a portion of the down payment up to 10%. So that 10% that the seller is lending as part of the buyer's down payment would be registered on title, which is now in the buyer's name, as a second mortgage. Now, if the seller owns the property outright, then they can still use seller financing, but they're probably going to require a much bigger down payment. And then the remainder is seller financed. And then in that case, the seller would register a first mortgage on title to the property, which of course is in the buyer's name. So why would we use an agreement for sale when we can do a vendor takeback and have title? Well, if the seller owns it outright, he is unlikely to use a vendor takeback because title transfers and the buyer then owes 80% loan to value. Most people aren't going to be comfortable with that, with title transferring. So if we have title still in the seller's name, it gives the seller security of having the title still in his name, and we can buy the property. And of course, we get no mortgage qualification. And the big thing for, in addition to that, is little to no down payment. Because if you were doing a vendor takeback, then again, you would need to either get a mortgage or have a big down payment. This way, with agreement for sale, we don't need that. So those are the main differences between vendor takeback and agreement for sale. Also, with agreement for sale, we are usually dealing with motivated sellers. Whether they're distressed or not, they're usually motivated. And then we're going to get good terms and price, and it facilitates their exit. And of course, our debt coverage ratio is not affected, which, as I have mentioned in the webinar before, is a great thing because that means we can buy properties that maybe only break even cash flow at this time, but we know that they're going to be great properties. Maybe we're getting a lot of free equity. Maybe we're getting really rapid mortgage pay down that makes it worthwhile to buy a property that's barely breaking even or even possibly slightly negative cash flow. But the debt coverage ratio, if we were buying that property conventionally and having it in mortgage in our name, that would negatively affect our debt coverage ratio and would also negatively affect our ability to get more mortgages. But with agreement for sale, we're not on the mortgage, so it doesn't affect our debt coverage ratio. And of course, we have multiple hold and exit strategies that we will go into detail on another day. And free equity is another wonderful thing about buying with agreement for sale and working with motivated sellers. So who are we working with? Well, it's either a prospect or a suspect. A prospect is somebody that you are likely going to be able to structure a deal with and work with, and a suspect, probably not. So a prospect is often a distressed seller, and they are having trouble selling the conventional way. It could be for many reasons. For example, maybe there's not enough equity in the property for them to work with a realtor. They'd be out of pocket. They can't afford to be out of pocket thousands and thousands of dollars, and that limits what they can do conventionally. Often they just need to sell for whatever reason, and we'll cover those in a minute. And there's always that sense of urgency with distressed sellers. It needs to be done now for a very specific reason that we need to find out from them. And you will hear that quite a bit. I just need out now. I just need it gone. And this makes them very willing to get more creative and be more flexible in both their terms and their price. Now, the distressed sellers that we often work with, they are either facing bankruptcy or foreclosure. And as we all know, if you have a foreclosure, then the bank will not consider you for another mortgage for at least 7 years. That foreclosure has to drop off your credit report before a bank will even look at you for another mortgage. So that's not a good option for people. Perhaps they're in arrears. It could be thousands of dollars, and they have no idea how they're going to get caught up, and they know it's just a downward spiral. Divorce is a huge reason why people might use agreement for sale, because suddenly you have the same amount of income split over 2 households, and it often doesn't work for people, and they need a quick solution. If they're moving out of the city, out of the province, out of the state, out of the country, they probably just want it gone right away. They don't want to have to worry about this house selling when they're somewhere else. And timing is very important there as well, because sometimes they're headed there at a specific time and they need this gone by a specific date. Fixer-uppers, of course, are usually purchased by investors anyway, and that means there's a more limited buyer appeal, more limited buyer pool for these properties. So if they're selling to an investor anyway, maybe they would be willing to do an agreement for sale. And with estate sales, it's very difficult and emotional to deal with the estate of a recently deceased loved one, and people often just want it gone. Of course, the low equity situation, as I mentioned, if you don't have enough equity in the property to pay the realtor's fees and the legal fees, then you're going to have trouble selling that property unless you have cash in your pocket to pay to get rid of your house, which isn't what most people want to do. And of course, with hoarders, it is not going to show well, and it is not going to sell very easily. And if it does sell, it'll be for a vastly discounted price. So this is a great option for somebody like that. And of course, we do deal with non-distressed sellers. There are some people who simply do not want to deal with a realtor. And as I mentioned before, often they're building new properties and need to coordinate the closings and have that flexibility. Landlords enjoy the benefits of saving loads and loads of money, thousands of dollars on capital gains tax by selling with agreement for sale, because they can split their capital gains tax over up to 5 years. And same with vacation homes. Secondary property can be capital gains tax split over up to 5 years. So that's really helpful. I helped my parents sell their vacation property this way, and it did save them over $10,000 in capital gains tax. And of course, with multifamily, it is a common way to buy and sell properties with either vendor takebacks or agreements for sale. Now, the suspects, they're going to want full market value and to not have to pay realtor's fees. They want their cake and they want to eat it too. And often those people are fishing, they're tire kicking. They want to call you up because they see, hey, here's an easy way to sell the house, but they still want all the money, even though they're putting in no effort. And they will be unwilling to negotiate, and probably will be a little bit unwilling to even provide the information you need on their mortgage. That's a sure sign that you're dealing with a suspect. Now, let's get into marketing. One way that we always have operating is a Facebook page for We Buy Houses. So people can stumble upon that page and contact us through there. You can place ads where people sell houses. So in, Real Estate Weekly or wherever people might be going to list a house for sale, you can place an ad there that We Buy Houses. Flyers or letters delivered or mailed is a very common way to go. And I did give that We Buy Houses letter that you would have got from the registration page for the course. But if you haven't grabbed that yet, it will be in the portal for you. And you can, depends on where you are, of course, but often you'll find that flyer delivery is cheaper than mail because stamps are darn expensive. And what we actually did was Our babysitter at the time, who was also a dog fosterer, would go on walks with her dogs and deliver flyers for us at the same time. Expired MLS listings are a good resource, especially if you have a realtor on your side who can feed those to you. And eventually, you might get to the point where you want to invest in a small billboard. And that would be either entering the area that you're targeting or in an area where your target seller might work. So, and that's if you're in a more blue collar area, you'll find that a lot of those billboards, small billboards, are pretty cheap. A colleague of mine has a few small billboards up, and they've had a huge success from that. But it is one of the more expensive choices. So, again, you want to be a bit more established before you go that way. Bandit signs. Those are the we buy houses signs, the we pay cash for houses, any situation, any condition. The reason they're called bandit signs is because the placement of these signs is in violation of most municipalities' bylaws. So you can get in trouble for putting signs up on public property, on other people's property, other businesses' property, and also things like stop signs and light posts. So be careful with those. Another option would be to have your own professional signs. This is mine. And what we do is when we have a property for rent, for sale, for rent to own, we put up the sign. So basically, as soon as we get the property under contract, then through renovations and all of that, we have the sign up. And then it will also, you might see the holes at the bottom there where we can hang a banner of whether this is going to be for sale, for rent to own, creative financing available, main floor suite, basement suite. So we use these signs for both our regular rental properties and our creative properties. And of course, you can keep these signs up at your own properties as long as you want. Or you can also get permission to put these up at somebody else's property. So for instance, if there's a house on the corner that is prime drive-by area for the neighborhood you're targeting, you might offer to pay a small fee to the homeowner for the privilege of putting your sign up. Calling FSBO, for sale by owner, online listings is a great way to get started, and it really helps you build your confidence in talking with people on the phone before you invest the money to have people call you. It's great practice to just make the calls and get out there and get used to talking to sellers and getting this information. Calling FSBO print listings as well. And there are still some people who only use print ads. I don't imagine they get a lot of traffic, so you could find some great prospects on print ads. Your own website, of course, is something that you will want to have at some point. How I got started was by doing my own website because as I got started, I had a lot more time than I had money. So I did my own website with a simple template. It was a free site that was provided through our Shaw Internet and did it myself. And that way, although it wasn't searchable through Google because it was a Shaw site, it was something that I could have on my business cards so that people could check out and then see that, yes, it is a legitimate business. Once your business gets rolling, you'll probably want to invest in a professionally designed site so that it is searchable on Google and comes up high in the rankings. A lot of people have success with doing how-to videos on YouTube. Unfortunately, I'm not one of them. I have never figured out all the algorithms and everything with YouTube to get viewers there. So unless people are specifically knowing that this video is there, they're not going to find it. So if anybody has some tips for me, I'm all ears. And Google AdWords is a great resource. Now that again is a paid resource, so it's probably something you want to do after you get a couple of deals under your belt and get some money coming in. And FSBO yard signs are a great thing to use because A, you know the area, you're targeting a market, and B, sometimes that's the only advertising that somebody has. They might not have any print because that costs money, or any online ads because maybe they just don't know how to do it. So for sale by owner signs on yards are great. Referrals are great as well. We've had a few sellers refer us to their friends for when they wanted to sell their house. It was quite a shock and pleasant surprise, I might say. Watch for tired landlords on the discussion forums on Facebook and other discussion groups. You will find a lot of people who are sick and tired of having thousands of dollars of damage done to their properties. Because let's face it, not everybody is cut out to be a landlord when they're doing their own property management. Anybody can own a rental property. Not everybody should manage it. And some of those landlords are just going to want out. And of course, they'll save in capital gains by selling this way. Drive around the area you like and look for dilapidated properties, because often the seller will be very happy to get rid of those. And of course, title is public record, so you can go to the Spin2 website, pull title, and find the owner's information, or just drop off a letter in the mailbox if it's still got private mailboxes. Your realtor can be a great resource, because sometimes they'll go to consult with a seller and find out that the house isn't worth as much as the seller had hoped. There's not enough equity to cover the realtor's fees, mortgage penalties, and legal fees, and they can't sell the conventional way. So if you have a few realtors who are feeding you those leads, they can be a great lead for you. Tax lien lists, I know that's very common in the States. I don't know of anyone who's using them here in Canada, but of course, that is definitely a list of people who are having financial trouble. So it could be a good resource. Foreclosure lists. Also, that is not something I use. I'm not a foreclosure expert. I prefer to have properties and contact sellers before they get that deep down the rabbit hole. Wholesalers. And this is with a question mark for a reason, because they can be questionable. So I have a few thoughts on them, and I have a recent experience with one of them. So I'll share that with you. Now, for anyone who doesn't know, when somebody wholesales a deal, so they've gone out, they've found all these deals and signed them, got them under contract, the purchase agreement is signed, and now they're trying to sell that purchase agreement to someone else. So they assign it to a new buyer to take over the deal, and then they get an assignment fee out of that. So that's what wholesaling is. And one of my questions is, what is their screening process like? How are they running the numbers? Is it even going to work for me? So I would need to thoroughly examine those numbers myself before I would take on the deal, because their version of a deal might not be the same as mine. Their purchase contract is a huge question for me, because I am able to put a whole lot of terms into the purchase contract in the additional terms section that make it very transparent what is happening, and it makes sure there's no ambiguity, that the contract is really clear so the seller knows in advance exactly what he's getting into. And that's really important to create a win-win and have a successful deal, that everybody knows what they're getting into. Now, I don't know what the wholesaler's contract is going to look like. It won't have any of the terms that I use that are important to me. I know that for sure. And are they creating a win-win? The guru that I learned agreement for sale from is an American with less integrity than I like to see, especially in someone teaching other people. And he was not teaching people to really go for a true win-win. And I know there are a lot of people taking courses out there for wholesaling that are maybe by similar type gurus. So it's a big question for me. And also their integrity and their ethics. If you already have worked with that person and know them, then you probably have a good idea what their level of integrity is. But if they're just calling you saying, hey, can I add you to our buyers list? You really don't know them at all. And there are several courses that teach wholesaling. And I know there's one coming up next weekend. And I expect that after the course, as per usual, I will be inundated with calls for approximately 2 to 3 weeks after, of all sorts of people asking me the exact same questions about what properties I'm looking for and can I add you to my buyers list. Many wholesalers are in it for a quick buck because let's face it, wholesaling is the quickest buck in real estate because you're not putting any money in. You're turning around, you're getting the deal under contract, you're turning around, flipping that deal within days or weeks, and you're taking a fee from it. So you're doing, and that fee could be $5,000, could be $15,000, depends on how good the deal is. So a lot of people are getting into it just for the quick buck. And my worry is they might be just assigning the deal to me and then washing their hands of it. And so they don't really care. They don't have any skin in the game. They don't have any vested interest in whether the deal will be successful or not. And that is the biggest thing that worries me about working with a wholesaler, especially if they aren't of the highest integrity and you don't have any idea about that from the start. So buyer beware. Now, let me tell you about my experience recently. I was approached by somebody, and then he gave me his pitch, and I asked him to email me the details. Here's the gist of it. He said he had 300 to 500 pre-foreclosures, and foreclosures are being dumped into my lap. Our initial offer will be secured with an average $5,000 initial deposit that will secure the property and be paid out a 2 times profit at the point of each sale. So his claim is that we would put in $5,000 or $10,000 and we would get double that amount of money back in a few months when the deal got flipped off to somebody else. He then said that all of our initial deposit would be returned to you after the first deal. That makes all future deals 100% funded by your profits. So we would put in the $5,000, then in a couple months, if we'd earn $10,000, we would get back the original 5, the other 5 would stay in the engine and keep turning over more deals. So my question there is, why would he give away all the profits for all of these future deals just based on this $5,000 initial upfront investment that we got back in a few months? If that was me, I would be doing anything I could to find $5,000 to get the deal done myself and then just keep all the profits. So that was a big question for me. That was, is this too good to be true? Second question is, why doesn't he have $5,000 if he's a successful real estate investor and realtor, I might add? And he wanted a retainer. And that was unclear if that would be applied to the property, to the expenses, or if it's a fee paid to him. And it wasn't really clear if the retainer was the initial deposit or if that was extra. So were we paying the initial deposit and a retainer, and then we get the initial investment back? Everything was very unclear. And it was a performance-based partnership agreement, but the only measure in the agreement of what the performance is whether he buys a house or not. So the retainer would be refundable if he didn't buy a property in 6 months. But there was no mention of what type of property it should be, of whether it should be positive cash flow or whether it should be bought under market value and by a minimum of how much. There was no measure of performance other than buying a property. So really, he could have bought the biggest dump of a condo in the deepest part of the hood and overpaid for it by a huge amount of money and had it be negative cash flow and probably vacant since it's in the hood. And he still would have fulfilled his part of the contract and then could keep that money. So I wasn't comfortable with any of that. The partnership agreement itself was also terrible. So what would his other contracts be like? Needless to say, I passed on the opportunity. There are good wholesalers out there, definitely, especially if they've learned from a reputable teacher. But use extreme caution if you're going to work with wholesalers. Now, back to better marketing methods. This is my website, cutiehomequest.com, and it also has We Buy Houses YEG. There's all sorts of different site names, domain names that lead to this website, which is handy. You can buy a whole bunch of domain names, have them go to your site. You don't actually have to have separate sites. One problem with that is you will get so many calls every year from website developers who see that you have this domain with no website attached to it. So I want to sell my house fast. This is part of my site, of course. Whether you are struggling with debt, leaving the province, or simply tired of being a landlord, QD HomeQuest can help eliminate the stress associated with selling your house in Edmonton. We buy houses in any condition in the greater Edmonton area, so you don't have to wait to sell your house. You can sell your house fast for cash, and we can close whenever you like. Are you stuck with a financial burden and a house you don't feel you can sell? Regardless of your situation or the condition of your house, we can tailor a solution to fit your unique needs in order to help you sell your house. There are many benefits to selling your house to QD HomeQuest. We can buy your house now, but close whenever you like. So if you would like a couple of months to find a new place, we can accommodate that. And it goes on with all sorts of benefits. Now, the We Buy Houses letter that you should have already gotten from the registration page, but again, is available in the portal. That's another great tool. We're buying houses from people just like you in your neighborhood, and we would very much like to discuss purchasing your property. We can buy your house quickly and let you get on with your life. Please note, we are not realtors, and we are not asking to list your home. We own a private investment company in Edmonton, and we are in the business of providing win-win solutions to financial dilemmas. That part about not being realtors is very important because often you will find, and you've probably received them yourself, that there will be letters similar to this, but it's actually from a realtor looking to list the house. Marketing basics. You want to usually focus on a specific area, especially when you're first getting started. And that's going to help you narrow down what your price is. You'll be able to know the market better, know the rents better, and it'll be easier for you to make quick decisions for getting started. Once you're more accustomed to dealing with AFS, then you can branch out a little bit further. Somebody was asking the other day about long distance deals. I definitely would not recommend long distance deals to start out. You want to be very comfortable in working with agreement for sale before you start having other people's feet on the ground helping you with your deals. So what I would recommend is stay within about an hour of where you live so that you can easily drive out to the properties and do the sales calls. And also, if you're doing rent to own, you probably will need to be out there to show the property. So know what type and price range of property you want. So for me, I'm always aiming for plain vanilla houses. In our area, that means 3 bedrooms, 2 baths, at least 1,000 square feet with a basement and a double car garage. The age of the house is personal preference. I like to have houses that are no more than about 50 years old. That's something, again, that's more plain vanilla here, but you need to work with probably plain vanilla in your area, and that could be different. And the reason why we want to stick with plain vanilla with the average house that you typically see, or average property that you typically see, is because there's the bigger buyer pool, the bigger rental pool. So if condos are very common in your area, for instance, if you're in the greater Toronto area, then condos are starter homes. That's the typical starter home there. So agreement for sale could be a great thing on condos there, not so much here in Alberta. So the price range, we also want to aim for a starter home or within a couple steps above, because again, it sticks to the more plain vanilla, bigger buyer pool, bigger rental pool. There's always demand for those houses. Once you get into more executive homes, you have a much smaller rental pool and buyer pool and rent to own pools. So we stay away from those. And the best scenario for marketing is when the seller calls you. So you want to focus your marketing on that goal. Now, as I said, you will probably want to start by making all the phone calls and getting practice with FSBO listings. But then eventually you want your marketing, and especially if it's paid marketing, that marketing should draw people to you. All right, now we're ready to talk to the seller. So we need to get the details on the property, the mortgage, and the seller's need, and make sure that you keep it conversational, keep that flow going. And then they're more likely to share with you. Now, I have the FSBO information script up here as a blank one, but I have one filled out here that I'm going to give you an example answer for. Okay. So this is assuming that we are calling a FSBO listing. So for instance, from Kijiji. Hi, I saw your ad on Kijiji. Are you the owner of the house? Oh, okay, you own it with your wife. Great. My name's Sherry Lynn, and what's your name? Sam. Nice to meet you, Sam. And could I confirm the address is 13651 St. Albert Trail Northwest? Great. And so what's that neighborhood called? Wellington. And what's around there? Is there schools, parks, shopping center? Oh, good. Golf course, shopping center. Oh, and it's near the main freeways. Excellent. And how long have you been trying to sell? 6 months. Okay. I read in the ad, but I've called a lot of places. So can you tell me more about the house? Now, you should have the ad up in front of you on your computer. So what you're doing now is just confirming details and getting any missing details. So when was it built? Oh, 1960. And how long have you owned it? Okay, 10 years. And that's a bungalow, right? And it was 5 bedrooms, 3 bathrooms. Great. And about 1,100 square feet? Perfect. Now it says single garage. Was that attached or detached? Okay. And was the basement professionally finished? Excellent. And is the house vacant? Okay. So when are you hoping to move? Oh, as soon as possible. May I ask the reason why you're moving? You bought a bigger house. Okay, that sounds great. Well, we're definitely looking to buy right away, and your house sounds perfect for what we need. You know, sometimes there's a way to make it work by doing something with the existing financing. You have a mortgage on the house, right? May I ask how much you owe on it? All right, now the seller will share mortgage details if you've kept it conversational and kept it with a nice flow to it. And if, I mean, obviously, I'm not having a conversation, I'm talking to myself. But you'll find that once you are talking with people, they'll say things that could lead you into more of a conversation. They might mention, oh, as a matter of fact, one seller said they were selling so they could move to a different city because they were putting their kid in a high school that had an intensive hockey program. So that leads into a bit of a conversation. Perhaps you can even get the person to laugh and get more friendly with them. And anytime that you can get more conversational, more friendly, then it will be easier to get these details. All right, so these are the financing details, and we're assuming, well, I'll pretend I'll talk to myself again. All right, so how much is owing on the mortgage? 250,000. And which lender is that with? Okay, Bank of Montreal. Now, do you happen to know what the interest rate is? Okay, 2%. So I'm assuming that's fixed then, because variable wouldn't be 2% now. Ha, ha, ha. And what's your monthly payment on that? Oh, 1550. Now, does that include taxes, property taxes? Oh, it does. Okay, so it's 271 in tax and the rest in mortgage payment. Excellent. Now, is there mortgage life insurance attached to your mortgage? There is. Okay. Now, side note, we don't want mortgage life insurance attached. It's a terrible product. We'll get into that another day. But that is something very important to know because we will want the people to cancel that. It won't be of their benefit to have it anymore anyway once we've bought the house. And when does your mortgage renew? 2.5 years. That's perfect. Now, are there any other mortgages or lines of credit secured against the house? Great. And are the payments up to date? They are. Perfect. And do you have any idea what the rent is in that area for a similar property? 1900. And there are no condo fees, homeowners association fees, anything like that? Excellent. Now, what kind of shape is the house in? So it's excellent condition. The basement is newly finished. Oh, that's a bonus. Does it need any repairs, any major upgrades? No. Now, do you have any idea how much houses around there are going for? Sorry, forgot to flip the side. You don't. Okay. So how did you arrive at your asking price? Through a realtor. So is the house listed with a realtor currently? No. Okay. Their asking price, by the way, was 359,900 on the ad, and they owe 250,000. So the let me ask you this, will you sell it for what you owe on it? We wouldn't ask that because there's too much equity. If there was not much equity, for instance, maybe even 50,000, I would probably ask, would you sell it for what you owe on it? Definitely if it's less than 50,000. Now, well, if we were to buy your house and close whenever you like, what's the least you could accept? 340. Oh, is that the best you can do? Now, at this point, they're going to either say, yes, it is, or if they give anything other than a very confident and direct, yes, that's the best we can do, then you know there's some wiggle room. So when you ask if that's the best you can do, they might say, well, we could probably go to 330. Well, then I'd ask again, okay, 330. And is that the best you can do? And you may find that they'll even go lower right there. So that gives you a starting point for you to run your numbers. This is not the price you're going to pay for the house, but we'll cover that another day. Okay, great. I need to check the numbers and we'll get back to you within the next couple of days. And so then you would pull the tax assessed value. It doesn't give an indication of true market value. I just like to pull it because if it's really, really out of whack, I want to find out more details on that. And we would pull comps. Usually we would use the realtor for that. To start with, comparable listings are helpful, but to really figure out what you're going to offer, you want comparable sales. All right, your agreement for sale team. Your team is so important. Together, everyone achieves more. Bookkeeping and accounting, of course, are critical. Unless you are a bookkeeper by trade or a bookkeeper at heart, you should hire a professional. And as far as accounting goes, I am incorporated because this is active income. So I absolutely have an accountant doing my taxes. For renovations and repairs, it's great to have a handyman that you can use regularly because often all it needs is a couple minor repairs. In one case, we had a couple of small paint touch-ups and a chandelier that needed replacing and a couple knobs, locks that needed replacing, and that was it. So a handyman, great to have. And of course, you do want to have a trusty contractor for full renovation. As I mentioned before, eventually you'll want to get your website professionally designed. So that is a big expense to get it done right. So that is something to do once your business is underway and you know that this is something you're going to be doing for a lot of profit. Flyer delivery, like I said, we used our babysitter at the time. So a local teenager who is trustworthy, even preteen who is trustworthy, can do that for you, or your own kid even. And property management usually only comes into play when you're having it as a regular rental. If you're doing rent to own, then you normally don't need a property manager. Your insurance agent is important because you want to be able to have a policy that is in your name. Now, remember, you're not on mortgage. So typically with most insurance agents, they are going to keep the titled owner who is on the mortgage as the owner of the policy. But with our insurance agent, we're able to have the policy in our name, it's our policy, and the titled owner who is still on the mortgage is the first loss payable. So it's a way to get the insurance in our names as our policy, and that to me is very important. You will likely eventually need a mortgage broker or a banker if you're buying properties that you plan to refinance later. So especially if you're doing a fix and refinance. Or in my case, we specialize in legally suited properties with secondary dwellings. So if I find a property on agreement for sale that I can buy with creative financing for a couple of years, I'm probably going to eventually want to put that into my regular rental portfolio and refinance it. Your realtor is very important for pulling those comparables and sometimes to get CMAs, which is a comparative market analysis. That's when they pull the comparables and analyze them for you. So if you're not good at or don't like analyzing comparables, your realtor can do that for you. Our realtor charges $50 to pull comparables, and it's either 100 or 150 if she's doing the full CMA and analyzing them for us. So if it was a property that was in an area I'm not familiar with, then or it was a little bit outside of plain vanilla, I might get her to do the full CMA. And of course, referrals. If you run those numbers and they don't work for you, or if it turns out it's not a property that you want to work with, then you can refer that property to your realtor. Now, you do want to ask the seller's permission to pass along the contact details to your realtor. And of course, you need an agreement for sale friendly lawyer, plural, because you want somebody who can do the deals for you. And especially later when you're doing the sale, it's a little complicated because it's not a sale from you to someone else. It's a sale from the initial seller to someone else through you. So what this lawyer will do is what's called a simultaneous close. Don't worry about that. That's a lawyer problem. But you do need to make sure that your lawyer is really familiar with agreements for sale, because not every lawyer works with them. And you do want more than one, because of course we always want to recommend to our sellers that they consult their own independent legal counsel. So it's nice to have a lawyer who understands agreements for sale that you can refer those people to, because if you send those people to a regular real estate lawyer, or if they already have a regular real estate lawyer that they have worked with before, and they go to that lawyer could kill the deal just because he doesn't understand it. An appraiser is somebody that you may find you need, again, if the property is slightly off plain vanilla. So for example, we got one property where there was back alley access that led to the garage, and that was what all of the residents used, but there was no street. So no street access. The property faced a park. So there was no street parking, no street to drive down. There, if you were a guest of the property, you would have to park a block or two away, depending on how busy it was, and then walk around the neighborhood to the front door. So that was definitely not plain vanilla for what I'm used to dealing with. And for that one, we got an appraiser, and everything looked great. We did a deal on the property and it was fine. But yeah, sometimes you do want an appraiser. And regardless of whether or not you're going to get an appraisal or a home inspection, you want to have that as conditions on your contract. But we'll get into that when we cover filling out the contracts. Home inspections, I think everyone should always get home inspections, even if you have owned properties forever and know exactly how everything works and what to look for. A home inspector is a really good set of eyes. It's easy to miss things. And when you have a home inspector there, they're there for at least 2 hours. So you're stuck there for 2 hours, and you yourself are going to have a better look around. And what I like to do when the home inspector is doing his thing is I like to walk around with my handyman or contractor, depending on what we're looking at for how big of a renovation it's going to be. And we make our to-do list and a supply list while the home inspection is taking place. Private lenders might be something you need, or if you're doing a big renovation, or sometimes you come across a deal that is not low money down, but it's such a wonderful deal. Maybe you're getting a lot of free equity, maybe you're getting a huge mortgage pay down, but that seller may have a lot of equity in the property and may want a good chunk of it now. If the deal is really sweet, you're going to want to find that money to make the deal work. So sometimes you might need a private lender. And eventually you probably want an assistant or a virtual assistant once you have a lot of calls coming in, or when you want somebody to make the FSBO calls for you. That's a great use for an assistant rather than you doing it yourself. Incorporation is a big question. This is creative investing, and it is often active income. because it's basically a long-term flip. When you're buying with the intention of selling within a couple of years, that's pretty short term in real estate terms. It's seen as a flip, and it's any time you have a short-term deal with the intention of selling right away. So it's usually active income, and active income, when you're incorporated, has a very beneficial small business tax rate. So you definitely should speak to your accountant about tax rates for active and passive income within corporations. And that will also help you decide whether, because if you're buying a property with the intention of holding it, you may decide to not buy it within your corporation. But anytime you're buying a property with the intention of flipping it, it could be better in the corporation. So that is something you need to talk to your tax accountant about to get what's right for you. Keys to success for agreements for sale. Of course, we want to create win-win scenarios. You need to be a solution provider and always approach the seller with that in mind, that you're there to provide a solution and, of course, make some money along the way. Be proud of your business because, again, you're a solution provider. Without you, these people would be facing foreclosure and homelessness. And demonstrate confidence with your sellers. So even if it's the first time you're picking up the phone and calling a FSBO, try to pretend like it's your 100th time and just, as the saying goes, fake it till you make it. You'll find the confidence will come, and that's why we need to practice. Always assume a yes. Remember, we never want to assume what a seller's motivation is. We need to find out their needs. And if we can fill those needs, if we can be the solution provider for them, then a yes is probably on the way. And I have had people who were very cautious people by nature, and they knew that I was a good solution, but weren't 100% sure that they wanted to risk still being on mortgage and title. In that case, I provided references, which were my lawyer and my accountant. And that made all the difference by having those professionals speak to my sellers. If you get testimonials from previous clients, from previous sellers, and put those on your website, that can really lead to a yes. And as I mentioned, practice makes closer to perfect. So we got to get out there and practice. And speaking of which, here's the homework. So I want you to go to the portal and print a few of those FSBO scripts, and then make some calls. Do 3 calls minimum, better to do 5. Then bring those sheets to the Q&A call, and we will role play some of the calls and review the sheets. Now, ideally, you can send the sheets to me in advance at sherilyn@sherilyn.ca, and then I'll be ready. It would be better if I can review before we choose which ones to use. But also, if you think you have a good prospect that you might actually want to buy, definitely send that to me and I'll review it with you, and we can potentially get something moving. Because if you call them on Sunday evening, you don't want to be waiting till Wednesday to deal with that. So you want to get back to them right away. And watch your email for the Zoom link for the Q&A call. It should be coming to you soon. Now in the portal, of course, the replay is there. The slides will be there. The transcript will be there soon if it's not already. And the FSBO script. And of course, there's also a calling log and the We Buy Houses letter if you haven't already grabbed that. And we have a Facebook group, the Creative Real Estate Investors Mastermind. So feel free to join that. It has not been very active to date, but I do plan on changing that because we are going to be doing more mastermindy kind of stuff in this course. So let's join that and we'll keep the conversation going. Excellent. Well, thank you for joining me today, and I will see you at the Q&A call.